because the equity is good. The earnings per share has been good. The sales actually has been good. The free cash flow has been good. The cash from OA has been good, but the ROIC has not been good. The ROIC has not been good. So, and also the gross profit is good too. This is why it gets a B. A lot of the things are good, just the ROIC has been bad. We can see over here, same thing. Except over here, the equity looking bad, the earnings per share looking poor. So the YOY growth grade, we're giving it a D. And we can see that it has a beta of 1.65. This suggests that the asset is more volatile than the rest of the market. The PEG ratio of 16.7 suggests that the stock is overpriced. So we're thinking the stock could be overpriced. We're looking at the return on investment. 7.8 suggests that the management is inefficient, or it could reflect a highly capitalized, conservatively operated business with little long-term debt. We look at the return on invested capital, and of 6.1% suggests that a company may not be able to fund future growth from within. We look at the return on equity of 7.3 suggests that the management is inefficient, or it could reflect a highly capitalized, conservatively operated business with little long-term debt. We look at the current ratio of 3.3 suggests that the money that could be working for the business is tied up in government securities, cash savings, or other safe funds. So we're not looking at big gains over here. Equity ratio of 52.6% suggests that a reasonably large percent of the company's assets financed by shareholders' equity. Debt to equity ratio of 90.1%. 91.1% suggests that the greater risk assumed by creditors, hence greater interest by them in the way the company is being managed. So these are actually sort of bad, but the good news is the debt FCF. This suggests of 2.92 suggests that the company is doing well and can pay off its long-term debt within 3 years. We got the value price. The value price, called the fundamental value or intrinsic value, is ordinarily calculated by summing the future income generated by the asset and discounting it to the present value. And we know that the value price is looking good. The MOS price, margin of safety, it is set to 50% of the value price. As Warren Buffett says, I always want to buy $1 of value for 50 cents. So these are looking good. The margin of safety is this difference between the intrinsic value